If the stock market crashes today, are you ready for it? Here are 3 things you need to do to prepare for a stock market crash. Hi guys, Stanley here. The stock market has been jittery in the recent weeks. Last week we saw a sudden drop in the S&P 500 index, but overall interest in the stock market is still very high. More investors are coming on into the market and many are chasing after the next hot stocks. But is a crash coming soon? Well, a typical market cycle looks like this. First, we'll have a slow advance in the market as the value investors start finding bargains in the stock market after the last crisis. This will be considered as the stealth phase, where most investors are still avoiding stocks as they are licking their wounds from the last crisis. But the few investors who can put their emotion aside and take advantage of the low market will start investing. On top of that, as companies recover from the financial crisis, their performance will start to improve. These will lead to even lower valuation of stocks, attracting more investors to invest again. Then the market will go into the awareness phase, where things are back to normal. Businesses are growing again, banks are lending again, institutional investors are selling off their safe assets like bonds and cash and investing them into the stock market. This phase could take years as the market continues to develop and the economy starts growing. During this period, there might be sudden sell-off or correction once in a while. However, the general trend is still good as confidence in the economy and the market continue to improve. This is the period where more investors will start investing into funds as well, adding more liquidity into the market. As stocks outperform other asset classes, they will gain more media attention. And as there are more coverage of stocks, it will attract other investors who might have been on the sideline over the past few years to start investing. More investors will lead to even higher stock prices, which will create more news. News like how an old dying game retailer has seen its share price shot up more than 10 times in few weeks. Or news like new companies that are disrupting an industry, like how the electric vehicles might destroy all internal combustion engine cars. This will lead to an even more excitement about the stock market and how there is a new paradigm in investing, and old school investors like Warren Buffett are considered too old-fashioned. The value investors will be behind times, and this is the era of the growth investor. This is when most of us are making money in the stock market, and it is actually quite hard to lose money in this kind of market. We will feel that all of us has become stock market geniuses and everything we touch turn into gold. But of course, nothing lasts forever. Sooner or later, it will reach a point where the music has to stop. The market will start to drop, but most investors will still see it as just a correction and might even buy more. Then ultimately, we'll see a major crash. A crash that might drop 50, 60, 70 or even 80%, until a point where most investors would give up on stock completely. Then, at the point of maximum pessimism, the value investors will start returning and picking up bargains, making the stock market recover again. But of course, these are just theories. Sometimes it does not happen exactly like this, but we have seen such cycle happen before across different asset classes. We saw it during the subprime bubble in 2008, both in the property and the stock market. We saw it with the cryptocurrency during the first major boom back in 2018, where all mainstream media started having a crypto division to cover the asset class, and that really helped fuel the bubble. So this cycle can happen in any asset classes, but they also come and goes. After the collapse of Bitcoin prices back in 2018, it took a few years, but now we are back with crypto fever and ever higher prices. Thus, asset classes will still be around, be it property, stock, gold, or cryptocurrency. But the issue here is nobody can predict the future, so nobody will know when the bubble will pop. We talked about why it is futile to try to predict the market before, so remember to check out that video as well. However, we do know that after a crash, the asset classes tend to recover over the long term, and most major asset classes are still growing in value over time. This is because of inflation and our cash is slowly depreciating away. Thus, assets around the world will continue to cost more and more over the long term. Therefore, the key for us is not to predict the crash, but rather to know how to survive it so we can enjoy the next boom. And after investing over the past 15 years, I believe that there are 3 key things that we can do to better prepare ourselves in the long run. The first thing is to use debt moderately. The only way that we can truly die in the stock market is by leveraging up too much. If we have too much debt and if we are using margin to invest in our stock market, we will be forced to sell this stock as the market falls. And we could even lose more than what we have. Of course, I'm not saying that we should have no debt at all. Some debt can be good for us if we know how to manage it well. For example, if we have a mortgage to an investment property and that property is generating enough cash for us to service that mortgage, we are probably fine. What we need to take note of is our short-term debts. These might be stocks margin account or even our credit card debt. As we need to pay this back very soon, it will cause a serious issue for us if the stock market falls and we do not have enough money to pay these debts back. So try to look at your debt and make sure that you have enough to service them even in the case of a market crash. Next, during such a bull market where there is more speculation going on in the market, we should actually be more and more conservative. Instead of joining in the frenzy, we should be running the other way and positioning our portfolio for safety and stability. This means that instead of investing heavily in a new startup-like stocks that are all planning to change the world, but having trouble to show a profit, we should be focusing more on stable and profitable company. This will ensure that our portfolio will be mainly filled with companies that have the highest chance of surviving a crash or a crisis, and be well positioned to recover when the crisis is over. This is also a good idea to have a good diversification across your investment. Sure, we have seen many investors making a fortune buying just one stock or betting big on cryptocurrency. That's great, happy for them. But from a safety standpoint, wouldn't you want your wealth to be more secure and not dependent on just one CEO or one asset class? For example, I do invest mostly in stocks, but I own close to 40 stocks in my portfolio. This means that I'm not too worried if one of my stocks turn out to be a fraudulent company or it is a business that is completely disrupted in the future. On top of that, I also diversify my investment into other asset classes like property, cryptocurrency, and others. Sometimes investing is more about the preservation of our wealth rather than the pursuit of the riches. And lastly, we should not get overconfident during this period. I know after a decade of a long bull market, we might be starting to feel good about ourselves. We might feel that we are geniuses to be able to make money in the stock market. But the sad truth is, a rising tide rises all boats. We have to understand that investing is a combination of skill and luck. And luck has been on our side in recent years. So if we assume that every stock that we buy will rise, it is a recipe for disaster. Because investing is a game of probability. We will win some and we will lose some. So stay humble and be patient. If a stock rises after we bought them, that's great. But if it doesn't, we don't have to be too eager to sell it off as well. Focus on the fundamental of the business and not the stock price. The stock doesn't care if we own them or not. So it might take a while before we start seeing some good returns in our portfolio. For example, when I invested in Xiaomi Corp, the stock price went down more than 50% in the first year before recovering and making me a good profit on the stock. Or when I invested in an e-commerce company in Latin America called Mercado Libre back in 2015. Within the first year, the stock actually dropped 25%. But by focusing on the fundamentals, I can see that the business are still doing fine and growing well. I held on to it till today, and the stock is up close to 11 times my capital. Investing is a voting machine in the short run, but a weighing machine in the long run. So remember to play the weighing game and not the voting game. When we are investing, most of us are planning to invest for an ultimate financial goal, be it to be financially free or to have enough for our kids. That means that we are investing for a long-term objective. So we should also set up our portfolio for a long-term success, one that can survive the up and down of a market, instead of just chasing the next hot stock. I hope this video will help you in your investing journey. If you have gotten value out of this video, please give us a like, share and subscribe to our channel so you get more of such video every week. And if you want to learn more about investing, remember to head over to valueinvestasia.com/free course, where we'll explain in greater detail the basics of investing. Thank you for your time. As always, my name is Stanley. Till we meet again, invest safely.